Alibaba is pivoting hard. Under Chief Executive Officer Eddie Wu, China's e-commerce and cloud leader is going all in on artificial intelligence. In the first quarter of fiscal 2027, total revenue rose about 9% to roughly 268.9 billion renminbi, or about $39.6 billion, delivering a slight top-line beat. However, net income plummeted approximately 75% to 10.4 billion renminbi, or $1.5 billion. Non-GAAP earnings per American depositary share fell 42% to 8.52 renminbi, missing analyst expectations of 11.28 renminbi. This net income collapse was driven directly by heavy capital spending on AI infrastructure. A 4.5 billion renminbi impairment charge diverged sharply. China commerce revenue fell about 8% to 120.9 billion renminbi, dragged down by reduced consumer subsidies on Taobao and Tmall, while international digital commerce revenue was roughly flat. In contrast, instant commerce surged 45% to 36.7 billion renminbi, though local instant commerce recorded a loss of about 10 billion renminbi. Capital expenditures surged 75% to 67.7 billion renminbi as Alibaba aggressively built out compute infrastructure, keeping its three-year 380 billion renminbi capital allocation plan firmly on track with 190 billion renminbi already invested. Meanwhile, Alibaba Cloud external revenue accelerated 45%. AI product revenue reached 12.4 billion renminbi, representing an annualized run rate of $7.3 billion that management expects to approach $10 billion next quarter. Additionally, annualized recurring revenue for Model as a Service, keeping management's 30 billion renminbi year-end target within reach. Alicia Yap from Citigroup asked about the sharp capital expenditure increase and the expected return on invested capital. Management answered that global AI compute shortages will persist until at least 2030, offering high certainty for compute investments. But deploying proprietary T-head chips, which span graphic processing units, central processing units, and networking hardware, shortens that payback period to 2.5 years before generating strong cash flows. Charlene Liu from HSBC inquired about instant commerce and the future focus of the reorganized e-commerce divisions. Management explained that domestic operations are now grouped into 4 core segments: China e-commerce, quick commerce, international e-commerce, and global wholesale. They noted that Taobao and Tmall are deepening partnerships with brand sellers while leveraging platform artificial intelligence to streamline operations for white-label manufacturers. Management added that instant commerce is projected to reach profitability in fiscal 2029 and eventually generate 30% of total gross merchandise volume. Yang Bai from CICC asked about the long-term pace and drivers of cloud revenue growth. Management stated that external cloud revenue has now accelerated for 9 consecutive quarters, driven by expanding compute demand where infrastructure effectively serves as the new super app. They reiterated their goal of reaching $100 billion in external cloud revenue by 2030 with a 20% gross margin. An analyst whose firm was not announced asked whether the Model as a Service year-end target remains achievable and how margins compare between proprietary and third-party models. Management confirmed they are keeping the 30 billion renminbi target for year-end, adding that host gross margins for proprietary models and third-party models on the Balian platform are highly comparable. Alex Yao from JP Morgan asked where commercial value will concentrate across the full stack AI. Management answered that short-term value concentrates heavily in chips and compute infrastructure, noting that over 500,000 units of prior generation T-head chips have shipped and the latest generation is actively powering cloud supernodes. They added that API pricing is merely a transitional business model, profitability for durable long-term AI revenue. By building out full-stack cloud infrastructure and scaling proprietary silicon, the company is positioning itself as the indispensable foundation for China's artificial intelligence economy.